Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And just to let you know, I've actually published a new report which summarizes the evidence-based strategies associated with investing in both property and shares and outlines that hopefully in a really simple and easy manner for you to understand and brings together, a lot of the stuff that I talk about in this podcast. So, of course, there's a download link in the show notes. And what I'd like to ask is if you download it and read it and enjoy it, and you know of anyone that would also benefit from reading it, if you could share it for me, that would be absolutely fantastic. Okay, in today's episode, I want to talk about property ownership structures. And I can't believe I've been doing this podcast for so long that I haven't had an episode to discuss property ownership because it's such an important decision. When you first buy a property, you're going to have to live with your decision in terms of how you own that asset for really the entire life that you hold that property, because changing the ownership of a property after you buy it, so down the track, tends to be cost prohibitive, because it can trigger capital gains tax and stamp duty. And typically the cost associated with that is much greater than the potential benefits, at least of all the ones that I've looked at associated with changing the ownership. So you've got to think then carefully about what ownership structure is going to suit you today and in the short term. What about the medium term and then the long term? And of course, you can't necessarily prioritize any of those time horizons necessarily, but what you hope to do is kind of balance it all out. And so today I want to talk about what are the factors that you need to consider, and then I'm going to talk about owning property in personal names and trusts and so forth. And so hopefully that gives you a bit of context and more information to get a greater appreciation for how important the property ownership decision is. Okay, there's heaps of considerations that we need to take into account when thinking about property ownership. And I would say that there's many factors. Sometimes some of those factors can be more important than others, and it's going to depend on your personal circumstances as well. It's going to depend on if you have other assets, how you earn your income, what stage of life you're at, all these sorts of things. So it's not necessary that, one particular factor is going to be most important for everyone. It's going to be circumstantial. It depends on your situation. But the reality is that every ownership structure has its pros and cons. And so what you're trying to do with property ownership structure is find the best balance between all those pros and cons at an asset level, but most importantly at a portfolio level. So, you might have property in different ownership structures to mitigate or balance out some of the cons associated with those different ownership structures, if that makes sense. I hope that makes sense. Okay, so I think there's I can put it into 5 categories, the considerations that we would normally take into account when thinking about property ownership. And it's not an exhaustive list, of course, because again, everyone's circumstance is different. But the first one is tax implications. So for long-term investors, typically I would say that the negative gearing benefits are more important than the potential capital gains tax outcomes. That means having a structure that maximizes your tax benefits earlier on in owning that property, even if it gives rise to a greater potential capital gains tax liability in 10, 20, 30 years' time, typically is a better approach, right? So when we're thinking about taxes, the first ones I want to talk about as income tax, which is going to be negative gearing benefits while the property has more expenses than it has income. And then income tax liabilities when the property starts to produce a lot of income. And for residential property, which is really this discussion today, it's probably not going to ever produce a substantial amount of income. So that the income tax liabilities probably don't need to put a lot of concern or weight on those. It's really more the negative gearing benefit. And remember, when we go and buy a property, typically most people borrow the full cost of that acquisition. So we're not putting any money into it, which means we don't have any capital in the asset. Our only capital, our only contribution to that asset is its holding costs. Now, if we holding everything else equal in terms of capital growth, for instance, the less we put into that property, the lower its holding costs are, the higher the internal rate of return, the better return we're getting, obviously. So it's really important to try and minimize those holding costs. And one of the best ways you can do that is maximize your negative gearing benefits. The other tax to consider is land tax. Tends to be quite insidious in that you might not pay land tax at all, or if you're going to pay some, very little when you first purchase the property. But if you buy an investment grade property, which by definition is a land heavy or land rich property, hopefully one in a location where the underlying land is actually appreciating at a considerable rate over a long period of time, it will mean that it's going to be a land tax heavy asset as well. So you just want to think about, does the ownership structure have any impact on those land tax liabilities? There's nothing we can do about land tax, of course. It is what it is. And if we have a great asset that has a really strong land value component and it's in an investment grade location, we're going to get really strong capital growth as well. So we'll be compensated for it. It's really just a question of, if I choose this structure, does it give rise to any more land tax than I really need to pay? Okay, the next consideration after tax is borrowing capacity. So, of course, I've spoken about this before in this podcast, that investment grade assets, there's a lot of them. Okay, so an asset that might be regarded as an investment grade from property perspective might be 5% or fewer properties in Australia. But the point is that there's a lot of assets, right? There's a lot of properties to buy. That's not really my scarce asset. As an investor, my scarce asset is borrowing capacity. And then therefore, how do I allocate that scarce asset, so borrowing capacity, to achieve the highest return? So the thing then to think about is, does the ownership structure limit my borrowing capacity? Does it limit the number of lenders I can deal with? Does it make it really difficult to refinance and pull out equity? But borrowing considerations is one of the factors that we think about. The next one is estate planning. So, how does the property ownership link in with the overall estate plan? So do we want to keep assets out of the estate if we think it's going to be challenged? Do we have assets that we think are going to be surplus assets that we would like to hand over to our children or our relatives at some point? And can we do that tax effectively and cost effectively? So that estate planning's a consideration. Exit strategy would be the fourth consideration. So what are we going to do with this asset? Is it a case of holding it for long term and we don't, because we've got such a long time until we're retire? Certainly if you're in, say, your 30s, you don't need to worry about debt repayment. Or is it a case of, well, we've got this asset, we don't plan on ever selling it, but at some point we're going to have to reduce the debt so that its cash flow will be at least neutral by the time we get to retirement? If so, then is it a tax effective structure that allows us to repay debt tax effectively? And some of this will start to make a little bit more sense as I get into the examples of different ownership structures. Or is it a case of, I'm going to need to sell this asset at some point, hopefully many decades down the track, but at some point I'm going to need to sell the asset. So then I need to think about, the capital gains tax consequences and the cash flow consequences in terms of where those monies are going to go in the long run. And lastly, asset protection considerations. So that would be appropriate for anyone that's in a high risk occupation or a director of a high risk business. I don't want to downplay asset protection considerations, but I think my general view on it is that asset protection risks tend to be over-exaggerated, typically by lawyers wanting to sell services, of course, or people wanting to sell more complex structures. But it's something to think about. There certainly are categories of people that are higher risk. We just need to assess that risk after you account for things like insurances, corporate structures, these sorts of things. Whether there's actually material residual risk depends on your individual situation, but certainly asset protection will be one of those things. As I said, there's no one particular factor that's more important or tends to be more important. It really does depend on individual situation. And what you're trying to do, as I said, is get a bit of a balance across all these factors. Okay, so let's talk about the different ownership structures then. And the first one I want to talk about is owning property in your personal name. And this tends to be the most common ownership structure, of course, because it's very simple, it's very cost effective. But of course, there are pros and cons to owning property in personal names. So what I'm going to do for each of these ownership structures, I'm going to talk to each of those considerations: tax, borrowing capacity, estate planning, exit strategy, and asset protection. And then I'm going to just highlight some additional considerations if they exist. And I'm going to go through all those different ownership structures to give you that overview. If you find that information kind of a little bit too much to absorb in a podcast course, I would say go and have a look at the blog on the website. It's all in written format there for you. So let's talk about tax for personal owned property. Typically, owning personal property in personal name maximizes the negative gearing benefits, particularly if it's predominantly owned or wholly owned by the highest income earner in a family unit. And so that's a benefit. Of course, it's a fixed ownership entitlement, which means it doesn't really necessarily give rise or help us minimize any capital gains tax obligations. And also, if we put a property in the highest income earner's name today, but the relative incomes between two spouses in a family unit changes, well, because it's cost prohibitive to change the ownership of an asset, that's something we have to live with. It's a fixed percentage. And there's no additional land tax obligation, so there's no surcharge there for owning property in personal names. From borrowing perspective, nothing to see here. It's all good. Nothing really changes. Estate planning, it depends on how you own the property. So hopefully people are aware we can own property in personal names in two different ways. We can either have joint ownership, which is how most people own their home. Say with their spouse, they would be joint owners. Essentially, there's several names, more than one name on the title, and the assumption is that everyone owns that property in equal parts. So if there's three people on the title, then we all have a third ownership, for instance. The alternate way to own a property with other parties is what's called tenants in common. With tenants in common, we get to ascribe a certain ownership percentage. So, for example, my wife might own 70% and I own 30%. Now, how this works in estate planning, with jointly owned property, what happens is the ownership automatically transfers to the remaining or surviving joint tenants. So again, if, Stuart, John and Paul own a property and Stuart dies, then John and Paul end up being the sole owners of that property, 50-50 essentially. Whereas if it's owned tenants in common, so going back to the example with my wife and I, if my wife owns 70% and I own 30%, I pass away, 30% goes into my estate and then is treated according to my will. So in terms of estate planning, if we want to keep assets outside of an estate, say for example, if we feel like our estate might be challenged by other parties, an ex-partner or children or family members, whatever it might be, then owning property in joint names tends to be a good strategy because it'll never hit the estate. Whereas if we're owning property with people outside of our family unit or certainly aren't beneficiaries to your will, so if you and a mate own a property, then own it as tenants in common because that means that your share of that property will come into your estate. So that's the estate planning considerations. Exit strategy. So one of the downsides to owning property in your personal name is that if you want to repay debt against that asset, you've got to do that with after-tax dollars, which means that you've got to earn income, pay tax on that income, which means then you've got after-tax income then to put in the offset account or pay against the loan. And if you are a higher income earner, it means you're paying 47%, and to save and reduce that loan, only 53% of your income is going towards that. So compared to other strategies or structures, depending on how you earn an income, that isn't always economical. And asset protection, the net equity of that property is at risk, right? So if you are an at-risk person and you want some asset protection and you would initially buy a property and you borrow 100% of its cost, well, it doesn't pose any asset protection risks today because you've got the asset and the debt and there's no net equity. But of course, if you hold that asset, it's a good asset and you hold it for 20 or 30 years, of course, then the equity will be at risk. And if you are genuinely an at-risk person, then it's something that you need to think about. So they're the 5 key considerations there. I just want to talk a little bit more about tenants in common ownership structure and a couple of benefits of using a tenants in common ownership structure. So the first common use that how we would use it is typically we might want a property to be owned predominantly by one spouse because they're the higher income earner. We won't necessarily put that property 100% in that higher income earner's name, particularly in a situation where both spouses are our client. In that situation, we would say that statistically, a relationship breakdown is probably our highest or most common asset protection risk, if you like. I hope obviously all our clients have very happy relationships, but statistically speaking. So in that situation, what we want to do then is have one spouse own 1% of the property and the higher income earning spouse own 99% of that property. And that means that we've got both spouses on title, which means if the relationship is to break down, no one party can deal with that asset. Like no one can sign a contract to sale and go and sell the property without the permission of the other party. Now, no one can really do that by law, in a family law matter anyway, but these things happen, right? And if people go and then sell the property, and then go and spend the money, you can't get blood from a stone, it's gone. So in terms of asset protection, having a 99-1 ownership, which is typically how we recommend most of our clients, not all, most of our clients own property, can provide some protection against a relationship breakdown, or at least control over that. The second situation where we would use a tenants in common ownership structure is where our client has cash savings or is expected to accumulate significant cash savings. So maybe I can demonstrate this better using an example. Let's say our clients go out and buy $1 million investment property and our clients have $300,000 of savings. Now, I would be saying to those clients, we're going to go and borrow, let's ignore costs, we're going to go and borrow $1 million because we want it fully geared and we want to have the flexibility to fully gear it in the future. But of course, you've got this $300,000, so of course you'll put it in the offset account to minimize interest. Now, in that situation, I might say to the client, let's say we've got one spouse that's working and one spouse that's not working who has a very low income. In that situation, I would say to this client, why don't we have the lower income earning spouse own somewhere between 30 and 40% of the property? Because remember, it's $1 million asset and we've got $300,000 in savings. So 30% of the property is kind of ungeared, if you like, if that $300,000 is in a linked offset account, which means that we've got some income, but let's have a little bit of interest deduction. So let's make it somewhere between 30 and 40%. So we'll have the lower income earner own that percentage and the higher income earner own the remaining share. So somewhere between 60 and 70% of the asset. Now, whilst the debt exposure at a family level doesn't change because we've got $1 million home loan, $300,000 in the offset, so we're paying interest on the net $700,000 amount. That's not going to change. But how it changes is that most of the interest expense is earned or deductible in the highest income earner's name. Whereas the lower income earner, they might have, let's say if they own 40% of the asset, again ignoring costs, they would have a $400,000 loan and then they would have a $300,000 in the offset account, so they'd have interest on $100,000 that they would pay. So they would get 40% of the rental and 40% of the associated expenses, but only interest on $100,000. So they would record probably a small profit. And if they don't have any other income, they're not going to pay any tax. Whereas the higher income earning spouse, their share, the remaining 60%, is 100% geared. They've got a $600,000 loan and they get 60% of the income. So it's just a way of us sharing some of the income to lowest income earners' name and shifting all or most of the interest liability to the highest income earners. Now, in that situation where we've got the lowest income earner, they've got a $400,000 loan and $300,000 in the offset. If they have future surplus cash flow, we would be putting it into that offset and we would offset the lowest income earner's debt first. Again, that's going to be most tax effective. So I think that wraps up really owning property in personal names. Let's talk about owning property in a family trust. Just as a general observation to kind of give you the summary before I get into the detail, we would typically not own property in a family trust, especially if our client is a PAYG employee, because negative gearing will be trapped inside the trust. A trust cannot distribute an income loss. So whilst the trust will eventually be able to utilize the negative gearing, they'll be able to offset it against future income. That might not happen for, 10 to 20 years. So you don't get any immediate negative gearing benefits, which is a big disadvantage. The other drawback, even if you are self-employed, is that trusts typically attract higher rates of land tax. Okay, so let's talk about the 5 considerations. So tax, of course, I've touched on that already. A trust can't distribute a loss, so you don't get the negative gearing benefits. So unless you're self-employed and you can distribute taxable income into that family trust to soak up the negative gearing, you're worse off. So certainly PAYG employees doesn't make sense. And if you're self-employed, you could get the benefit of negative gearing, but it depends on your business income structure. In terms of capital gains tax, it's probably the most flexible, because a family trust depends on the trust deed, but typically can distribute to multiple beneficiaries and individuals, and we can therefore spread any capital gain across multiple individuals and thereby reduce the amount of tax that we might pay from that perspective. But perhaps the biggest disadvantage from a taxation perspective, other than negative gearing being trapped, is land tax. Properties owned in a discretionary trust in most states attract higher rates of land tax, and I have written a blog about this previously and associated podcast, of course. I've got a link in that section of the blog on the website. So if you want to learn a little bit more about land tax, I would suggest you check that out. Borrowing through a family trust is typically okay. It doesn't really restrict your borrowing capacity or the amount of lenders that you can use and refinance to in the future. The only thing is that there's only a small number of lenders that allow you to have an offset account. So if we go and borrow inside a family trust, the trustees or the director of the trustees will need to provide a personal guarantee. That's fine, that's standard. But if we want to then have an offset account linked to that loan, that can be challenging, which means that there's only a couple of lenders. Still okay, they're still good lenders. You're not going to be worse off, but just in the future, if those lenders move out the market, it means there's fewer to compare with. So borrowing's okay, it's just the offset account. Estate planning, and trusts are really good for estate planning because they exist beyond your death. A trust lasts for 80 years before it vests. So really it's about just handing over control of the trust, and you do that within your will, which means you would nominate a replacement appointer, and the appointer is the one that can change the trustee. That's the main controlling position in a trust. So if I've got assets and I know I'd like to, create some intergenerational wealth and pass them on, a trust is a good vehicle for that to occur in. Exit strategy, well, it's just like owning property in personal name. Really, you've got to distribute the income to you individually, pay the tax for you to be then make a capital contribution into the trust to reduce the loan. So this is a situation where we want to have this asset and the strategy is to reduce debt over time. It's not as economical as other structures. But of course, if we go and sell the property, it's more effective because we can spread that capital gain as I've spoken about. And a family trust provides pretty good asset protection, particularly if you have a corporate trustee in place, because no one is entitled to the assets of a trust until the trustee makes an election to distribute those assets. So they're otherwise protected, and not necessarily from a family law matter. So relationship breakdown, the family law court tends to look through those structures, but certainly from a creditor action perspective. Okay, next ownership structure I want to talk about is owning property in a company, a non-trading company. Most accountants will say, no, don't put a property in a company because it's not entitled to the 50% capital gains tax discount. So, if you own a property in a trust or in personal names and you hold that asset for more than 12 months, you get to reduce the net capital gain by 50%. And you only pay tax on the remaining 50%, of course. Whereas in a company has a flat tax rate of either 25 or 30%, depending whether it's a small business entity, and it just pays tax at that flat rate on the net capital gain. There's no CGT discount. However, my counter argument to this is that yes, it will initially pay either 25 or 30%, but then if you're smart and you manage the dividends that are paid out of that company, essentially what you could end up doing is spreading that capital gain over many, many tax years, and potentially, depending on the quantum of that gain and how the shares are owned, potentially not pay any tax. Okay, even though you might have to, pay a bit up front, you might end up getting those tax refunds. So I think, from my perspective, I wouldn't just discount owning property in a company, but of course it depends on your individual situation. So let's talk about those 5 considerations then. So tax is the first one, of course. Negative gearing benefits, it's similar to a trust, in that a company can only pay a dividend, so make a distribution from retained earnings. If it has retained losses, it can't pay a dividend, which means that if you have a property inside a company and that property makes a loss, that loss is trapped inside that company. So if you're a PAYG, then a company's probably not going to be the right structure for you if it's fully geared. If it's got a much lower gearing rate, maybe it could. But if you're self-employed and you have the ability to distribute taxable income into that company, that non-trading company, to soak up the tax losses, then you're fine. You're just as good as having the negative gearing benefits in your personal name. As I said, because you get imputation credits, you always get a credit for the tax that a company pays. Even if it makes a big capital gain this year, what we would do is we would leave that profit, that capital gain in the company, and then we would pay out a dividend each year, maybe $60,000 or something like that, and maybe to both individuals if possible. And then we would pay out that $120,000 each year until the capital gain had disappeared. And that might take us 10 years. But what that might mean is that we pay 25 or 30% tax today, and then we get tax refunds for the next 10 years, thereby minimizing capital gains tax. So the fact that a company gets a credit for the tax, so they're called imputation credits or franking credits, is a really big advantage in helping us eventually minimize and potentially eradicate any capital gains tax. So I really like it from that perspective. And I've got a link where I talk about how franking credits and imputation credits work in a company environment. There's a link in the blog on the website to another blog that I've written on that. And lastly, in terms of land tax, no problems. There's no additional land tax if we own a property in a company name. In terms of borrowing, there shouldn't be any problems with borrowing inside a non-trading company. Of course, directors will need to provide personal guarantees, again, pretty standard. But just like the trust loans, getting an offset account can be challenging. There are a couple lenders, as I said, one of the big four offers company loans with offset accounts, but they're not common. So that's just the same consideration as a trust. Companies can be good for estate planning as well, in particular compared to trusts, because companies don't have to distribute its profit every year. If there's a way of just sort of quarantining those assets and the income and then not affecting any family group members as a result, or I'd say family individuals as a result, can be an advantage over and above a trust. Actually, a company and trust working together is probably the most optimal situation there. But because a company can live beyond the individuals, that just the shareholding transfers, well, you need to think about that, how that's dealt with in a will, whether the shares are owned by a family trust or whether they come into the estate. But it can be a good strategy there. Exit strategy, which is the next consideration. A company, if you're able to distribute taxable income into that company, it can be a really tax effective way of reducing debt also. So again, this is only really for self-employed individuals, but if I've got a non-trading investment company that owns a property, I can distribute business income in there. Potentially it's only taxed at 25%, so I keep 75% of the net income, and then I can put that towards reducing debt. So it's a tax effective way of buying a property if you're self-employed, and then using my income then to reduce the loan associated with that property. I've spoken about the other exit strategy. If we go and sell that asset, again, that can be quite tax effective as well. And asset protection depends on who owns the shares, whether you've got some asset protection there. So of course, if the shares are owned by you as an individual, then you've really got no asset protection if you get sued. But if the shares are in a family trust, then it gives you a greater level of asset protection. So just to sort of sum up, I think a company can be, in many circumstances, a great vehicle for self-employed individuals, but probably not appropriate for PAYG employees. Okay, the last ownership structure I want to talk about is owning property in a self-managed super fund. And I will say, typically, what I prefer in terms of structure is have gearing outside of super and my non-geared investments inside super. If I'm going to have geared investments, typically it's property, so property outside. If I'm going to have non-geared investments, typically shares, so shares inside super. That's typically what I prefer, and the reason for that is that I'm maximizing my negative gearing benefits if I have my property outside super. But let's talk about owning property inside super, which is a great segue into the first consideration being tax considerations. And exactly how I've just explained it, if we have property inside a self-managed super fund that has gearing against it, you borrowed to invest in that asset, and it produces a income loss, which is probably, if you borrowed more than 50 or 40% of the asset's value, it probably won't produce taxable income. Certainly they can get a tax break for that, but it's only at 15%. So if I've got an investment property that's making a $50,000 loss, I'm going to get a $7,500 tax benefit, being 15% of $50,000, of course. But if I had that $50,000, so that investment property in my my own personal name, my tax benefit's going to be probably somewhere between probably around $23,000 because I'm paying 47% outside super versus 15% inside super. So that's a big negative. It's a big negative to have property inside super because you don't get the same income tax benefits. And remember, that has a big impact on my internal rate of return because that's my only investment is the holding costs. I borrowed the full cost. My only thing I'm putting into this asset is the cash flow. If I minimize the amount I need to put into that asset, then I really, in percentage terms, maximize the return holding the capital growth constant. So that's a big negative. The big positive associated with having property inside super is capital gains tax. So if I sell a property and I'm still in accumulation phase, so I'm younger than 60 or 65, I'm going to pay 10%, a flat rate of 10% on capital gains, which is nothing. I mean, if you think it's less than half of the rate that I'll pay outside of super, which if I'm on my highest marginal tax rate, I'll pay 23.5% versus 10% inside super. Massive saving. Even better than that, if I get into pension phase and sell it in retirement, I'm not going to pay any capital gains tax, assuming your total super balance, your individual super balance is under $1.9 million. So really attractive from a capital gains tax perspective. And from a land tax perspective, no change. They don't attract any higher rates of land tax typically in most states. So if I was going to go and buy an investment property that I expected to make a really large capital gain on in a relatively short period of time, it might suit buying inside super. But, typically we're buying investment grade assets, going to hold them for several decades. And in the first couple of decades, when you get some material income tax benefits, super's probably not the best environment there. Borrowing capacity wise, there's some limitations there. Your borrowing capacity inside super is dictated by the super fund's historical income, which includes investment income and the primarily super contributions, so the amount that you've contributed. So of course we've got caps there, $30,000 each per year. So there's a limit on the amount of income we can get into super. Also, interest rates are higher, about 1% higher than interest rates outside of super, just because there's a lack of competition there. So borrowing isn't great. Inside super isn't as good as outside. Estate planning, it can be useful because, super's not part of your estate. It depends on the death benefit nomination you complete that instructs the trustee where to pay those monies. It doesn't necessarily hit your estate. Exit strategy, this is where really good, thorough long-term planning is really important because, paying down debt inside super can be a challenge. We can make concessional contributions, $30,000 a year. We can make non-concessional contributions. The cap is $120,000 a year. So if we've got heaps of cash, we can probably get a lot in there and repay the debt. But most people don't necessarily want to do that, particularly if they're far away from reaching sort of the retirement age because they're locking it away inside super. So depending on your situation, you just want to think about, how you're going to deal with the debt profile in the super fund. Secondly, the other consideration is, of course, property is an illiquid asset. And because super funds need to pay a minimum pension balance, it can create some problems. Problems where you're forced into a situation of selling a property asset when you otherwise really wouldn't want to. And the only reason you sell that asset is because you've got to pay these pensions. And, if it's a good compounding capital growth asset, it means the minimum pension and dollar value increases substantially each year, but you don't have necessarily the liquid assets to be able to pay that pension. So again, good long-term planning. If you plan around these things, it's not a big deal, right? But I find that most people don't, which tends to trip them up. And the last consideration, asset protection. Self-managed super funds provide great asset protection. They're actually protected from any claims in the event of a bankruptcy or anything like that. So they provide great asset protection. So to sum it all up, choosing the most suitable property ownership structure involves really assessing what existing assets you have and then also have a clear understanding, what your long-term strategy is. They're the two sort of things you need to weigh up. And the goal is to try and balance out the pros and cons of all these different ownership structures. And you need to then think about, how they work with other investments, how do you optimize tax, cash flow, overall investment outcomes at total portfolio level, if you like. And it really does require a kind of multifaceted approach. There's some tax considerations, there's some mortgage broking considerations, and of course there's financial planning considerations. And once again, I think demonstrates that, the person that's giving that advice needs to have that deep understanding of both property and shares being the two major asset classes. Bit of a longer one today. I apologize. There's a lot in this. As I said, feel free to go back and have a look at this in written format on the blog and the website. But look, I hope it's been good introduction. It's a long introduction into different ownership structures for property, but it really is an incredibly important decision. Okay, just a reminder, there's that link in the show notes to that report that I've written using evidence-based strategies to invest in property and shares. As I said, please share that if you know anyone that would benefit from it. And until next week, bye for now.